Hey everybody, Henry W. Steele, and this is December 10th, Monday, December 10th, 2018, and this is the 9th video in the series I'm doing on chart reading. I'm using the same as before, the United States dollar, Canadian dollar cross pair 4-hour chart. Keep things nice and uniform. Now in this video we're going to talk about forecasting time and price a bit. We're going to start on that, bringing the two together with one method. And I don't think I'm going to get to the end of explaining everything about this particular method, but we're going to look at the beginning of it and how to begin to use it. Now, this is an uptrend, very obvious in hindsight. It's once you can determine that you're in an uptrend, you want to use the retracements for this, and that would be bottoms in an uptrend. When you're in a downtrend, the retracements go to the top. So you would want to use the tops in a downtrend. Pretty simple. Let me zoom all the way over to our current price action here. Because we're in an uptrend, I'm going to be using bottoms, and all I'm going to be doing is using the Trendline tool to measure from one bottom to another bottom. And they don't have to be consecutive bottoms, but we'll go ahead and use these two right here, which are essentially consecutive bottoms of this particular magnitude. Now the Trendline tool and the MT4 platform is the only measuring tool they have. They don't have a little ruler where you can determine, look at it graphically. So all you have is this, and you have to select the tool, hold the mouse button to see these little numbers there. The numbers on the left of the slash, that's the number of candles or bars from the original starting point. So right here would be 43 candles. And the number on the right of the slash is the number of pips up or down from this point right here. So this right here is right at 43 bars and 71-ish pips, because that's actually to a precision of tenths, which means that's 70.7 pips that's shown right there. Okay, but all we're really interested in is the 43. So what we're going to do, we measure this, we see that we have 43 candles between these 2 points. So we're going to double that. 2 times 43, of course, is 86. So we're going to measure it to 86 right here. We're going to make sure our trend line is still on the same angle, or pitch, I guess you could say. And what we're going to do is look at the price, what the price action is doing in relation to the trend line at that 86th bar. And put a little line right there, and we see that the market is essentially at its top right here. Obviously it did move a little bit higher, but eventually it came back to the trend line. Now this is what we can expect to happen with the trend line. It's a lot like a moving average when used like this. If the market is away from the trend line at this doubled point, we can expect that movement away from the trend line to stop, to slow and stop, and then for the market to come back to the trend line. Okay? Now, sometimes the doubled point is right on the trend line, and in that case, this obviously is not going to work for us the same way, because what we're really looking for and expecting in most cases is for the market to be away from the trend line. Now, let's show you another example here so we can talk about it, or I can talk about it a little bit more. We're going to use this low, and let's use this little bitty low right here. 10 candles, so double that is 20 candles. Make sure the trend line's right there. This is the point in time, and this is a really good example here. Notice that the market moved away from the trend line way over here, and then was on the way back to the trend line when this doubled count came in. This doesn't mean that we're expecting the trend at this point in time. We're not expecting the trend to change. We're just expecting it to come back to the trend line. If it's at excuse me, if like over here when we measured this one, it was in the process of moving away from the trend line. If that's the case, then we expect that to slow, stop, and for it to come back to the trend line. But if, like in this case, it's already moving back to the trend line, we expect that to continue and for it to come back to the trend line. Okay, so this isn't, we're not looking for a change in trend specifically with this. We're looking for the market to come back to the trend line. Now, let's look for another example. We're going to use the same anchor point right here. And we're going to go to this low right here, which is 25 candles. We'll double that. Get to 50 candles. And here's another really good example. The market was the most extreme distance away from the trend line was right here, and it's already on its way back to the trend line. Now the market's moving sideways here, and the trend line's moving up, which means we would expect it to essentially move to the trend line without any real necessarily significant price movement to the downside because of this sideways move right there. But we still expect it to make it back to this trend line at some point. Or in some cases, we expect the trend line to make it up to where price is if it's just a very slow sideways market. Now let's move on to a different low. This one right here. Same anchor point. Whoops, used the wrong. We're going to use the same anchor point right there, but we're going to go to this low, which is 34 candles, so double that is 68, of course. We get right here. Then here's another scenario. This one's actually preferable in an uptrend. Now here's why. Right here, the uptrend, obviously the market moves up, it makes a retracement, then it moves up higher to a higher high in an uptrend, obviously. Now at this point in time, if we look, we see that the market is below the trend line. And since we're in an uptrend, we expect the market to move obviously to a higher high, or at least an equal high. And so if we're below the trend line when this doubling in time happens, we can expect the market to slow or stop, or if it's like right here, it's actually pretty much just moving sideways. If it's moving sideways like that, we can expect it to start to come back to the trend line just like it did. And we can expect it to exceed the trend line and continue up. Now there's obviously a chance that this could be a change in trend, in which case it would move back to the trend line and probably just head further and further down. But remember, this assumption is that the trend is going to continue. So after it gets to the trend line, it's going to continue away from the trend line, most probably after a bit of a pause is usually what happens. You might pause at the trend line, right past it, right before it, but then it will move further. So when we're in an uptrend and we show the point in time here and the market's below the trend line like this, that's a good thing because that means we can expect a larger price move most usually. If we're in a downtrend, obviously the opposite is true of that. Now, I'm going to show you one or two more examples of this before I show you another aspect of this that's going to help us zoom in onto some useful information. So let's look, get that out of the way. Let's look from this low to this low right there. Now notice that I've anchored all of these off of a pretty significant low right here. We really want our anchor point to be a decent significant low, and then go from there for a while. And just like this one, it doesn't have to be. I mean, we could use this one, we use that one, so forth and so on. We can use any of these, including this one right here, which is 49 candles later. Look how it cuts through there. Remember how I told you in the previous video, I don't care if it cuts through the price like that because that's not what I'm looking at. Now you know why, because I'm just looking at the amount of time from the anchor point to the next retracement low point, or not the next one necessarily, but to another retracement low point in that same uptrend. And again, if this was a downtrend, then we would be looking for retracement high points. So we have 49 candles here, so obviously double that is what, 98. So we have that right here, and this actually brings us to right now. The chart is live because today's Monday, so you might have seen price bouncing around over there. But this point you see right here, we can expect the movement that's going away from the trend line to cease, and we can expect the market to come back to the trend line, right? Whoops. Accidentally knocked my mouse right there. There we go. Get that back on track. So what we can expect at this point, and this is actually a bit of a forecast now, right, is that we can expect the market to, at the very least, move sideways or sideways to down to touch this trend line. Okay, now that's not a whole lot of price that we're going to get necessarily, and this isn't necessarily a method to use to want to actually get to a specific price or use, how should I say this? We're not looking for this to forecast a big move necessarily. We're looking at it as another way to anticipate what the market should be doing. In other words, what direction it should be moving, and give us a rough guesstimate as to how much the market could be moving. Excuse me. So as of right now, and we're getting signals to this, if we look at the momentum here, we see there's an increase in momentum here, but the trend didn't start there, so that would indicate exhaustion. We're getting some tails up here, which could indicate rejection of this price level. We have our trend line doubled point in time right here, which indicates that the market could be close to, as far away from this particular trend line as it's going to get in regards to this point in time, and we can expect it to move back probably pretty quickly. Now let's look at this one right down here. This is another very significant low. It's 64 candles away from there, so we can double that and get 128 right here. So that would indicate that it sure looks like the market's going to head back down in a stronger move at some point in time. Now keep in mind that excuse me, that doesn't mean it's going to happen anytime soon. This is 34-hour period, so that's 120 hours into the future, which is what? That's five full days, so that's 5 trading. That's 1 full week from now. So it'll be next Monday. Either the market's going to be as far away from this trend line as it can be at this point in time, or it's going to be right on the trend line. Either way, we can keep an eye on that going through the charts in the future. So, I mean, from here at this point, like, I could move that out of the way. I could use this low to that low and go into the future, or I could start with this low and that low over there and go into the future. But once I get a significant low like this, I'd want to use it. Like, there's a good low to use, and then this is a decent low. That's actually a decent low, and you can use really any point in time, but the more significant the low relative to the amount of time that you're using, the better it will turn out for your anchor point, which is the starting point of your trend line. Okay, so let's back up a little bit here. Let's go look at some of the stuff we already looked at, like this right here. 10 candles from here, we double that, we get 20 candles right there. Now, in this particular instance, we were much further away here than we are at the point where this time period has been doubled, right? So let's count the number of candles back from here to this extreme point. 1, 2, 3, 4, 5, 6. Essentially 6 candles. So if we count forward from this point 6 candles, we get 1, 2, 3, 4, 5, 6. We're actually on the trend line at that point in time. Okay? So you could probably figure out where I'm going with this. Let's measure this one. Again, there's a low, 25, double that. We have 50. Now, at this point, it's only 2 candles back, right? And then we go 2 candles forward and we're nowhere near it. But if we go 1, 2, 3, 4, 5, 6, 7, 8 candles back to this previous high, and then go 1, 2, 3, 4, 5, 6, 7, 8 candles over here, we get kind of a balance where After that, it moves down very quickly. So that didn't actually work out very well here, but there's a reason for that, and I am not going to go into it at this point because it's involved and it leads to other things, but regardless. So if we go down here to this point right here, which is the final low of this low, and that's something you need to keep your eyes on, our final lows or final highs, we get 34, double that is 68, which gives us this point right here. If we go 1, 2, 3, 4 here, we go 1, 2, 3, 4 here, and we're within a candle of the market moving up there. So essentially, what we're looking at is, and you can tell it's kind of balanced from side to side there, that the point in time that this measures is frequently pretty well balanced between extreme and touching the line, or touching the line previously and touching the line. So it can give an indication as to the future performance or behavior of the market. If we look at 49 right here, double that was of course 98 right there. So this one from here to here is 2 candles. So it would be within reason to think that 1, 2, at this point in time, right around this point in time, the market will be back at the trend line. Now let's look at another example. We have a low here. That's a decent low. We're going to skip this low right there and just go to this low right there. 61 candles, double that is 122 candles right there. And we see that we are 1 candle away from the high. And if we move 1 candle here, we're within a candle of there. See how it's just this highest close is right there, the highest candle is right there. Obviously that shows rejection at that point right there. And we move down and we're very quickly we're at the line. Now one thing you've probably noticed is this isn't extremely precise in this particular format, what I'm showing you, but it gives you a good idea of what's going to happen in the future. Now there are ways to improve upon this dramatically to the point where you can pinpoint prices and time frames together where you can expect the market to be, and if it's not there, then you know the other places it's going to be. I know it's a bit confusing, but it's probably a few days before we get to that kind of clarity with this method, but we'll get closer as time goes on. Okay, so you've probably figured, or you probably understand at this point, the basic method and then the balancing of this method. And if you're having any trouble with that, maybe watch the video again, rewatch the part that you're not understanding. And also keep in mind that as we go forward, we're going to look at this more so that we can, so that you'll understand it better, and then we're going to start using it to help us anticipate what the market might be doing. So until tomorrow, that'll be it for today.